Welcome to another episode. This episode I'll be discussing about the forms of ownership and funding overview for a business. And particularly it could be useful for a techie. And these days, even in India, there's a lot of discussions about the startup business and the startup ecosystem. The startup ecosystem which was not there about 2 decades back in India. Now there are a lot of discussion and lot of impetus is given to the startup business for the small organization, be it the state government or the central government. The focus is on small business or small entrepreneurship, which is called startup these days. So I'll be discussing about the forms of ownership and the funding overview for small business or the called the startup. Trying to do it in just about less than 10 minutes, or in about 10 minutes. Let me see whether I'll be able to do it within that time frame. So what are different ownership is available in India, particularly India. Before that, there are, for a new business, if you look at it, how do you want the business to be? You want the business to operate by yourself, by just a group of friends, and that is a common trend in India, particularly for a startup. Either it could be one person who would be interested or a group of persons who would be interested. So in that case, what are the options available in the Indian ecosystem, business ecosystem? We'll see that. That is what is the ownership is all about, whether it is proprietary or partnership or how it is going to be. And the critical point, yes, the techies want to start up a business, but what are the funding option? Whether it's going to be through equity. Equity is that when you bring in the funds, it is called the equity. Debt is what, when you borrow something, then it is called debt. When you bring in finance, then it is equity. And how are you going to, it is group of friends or it is from the external source also going to participate in the equity of the business or the capital of the business, then it is called the equity. But if it is through the borrowing, then it is known as the debt. The size of the investment, then is it a startup as well? You can't just a startup, it's very difficult to expect crores of rupees to be invested. Yes, these days that even that has become possible with the venture capital. So we will see that as well. So if you look at business scenario, generally, I mean, in India, even across the globe, the first one is the sole proprietorship, in which case you might, a person can be completely authorized to run the business, and even his the funding is from his own funding. Maybe he has maybe from his family has given this money, or from his own pocket he's providing that. Then in that case it becomes a sole proprietary, or it could be a partnership. A group of friends invest about 10,000 each, then it is 50,000, or that matter if they are going to invest 20,000, 20k each, then it becomes a 1 lakh of rupees which could be invested. In that case they have a partnership deed. So partnership deed list out how they are going to if it is profitable, how is the share is going to be. So these two are common. The third one is the corporation, where then you have a public limited company or a private limited company. The private limited company is what one expects, particularly when you get into the venture capital. Then apart from the partners investing 20,000 each to make it 1 lakh, the venture capital funding also comes in, maybe in millions, then you are venture funded. So this is the area where the startup generally focus on to become a private limited and then attract a venture capital, which was totally unheard about 2 decades back. So proprietary, the ownership is entirely with a single person. That is what is described here. A business owned by one man, single ownership, small business, retail outlet, fabrication shop, small manufacturing units. This is the common type. But now, yes, with venture capital, with the startup, when they go scale up needs to be very fast, then yes, it needs to be a private limited company. That is what even the venture capital looks for it. So whereas in the proprietary one, it's minimum cost, legal formalities, statutory needs are less. And one more point I want to stress on this is solopreneur. Even the taxation is made simple. Maintenance of books of account with the presumptive tax was introduced few years back by government of India with limited turnover. Now the presumptive tax, you don't need to maintain books of account based on the profitability. You can make the presumptive taxations about generally there are variations. I'm not going into the detail, but do understand presumptive taxation is possible now. You don't need to maintain books of accounts if you're adopting the presumptive taxation. But point to notice, there are terms and condition. You need to adhere to the terms and condition. So partnership, when group of individual try to enter, 3 or 4 friends join together, then it is partnership company. Proprietary is for a single. Legal binding is based on the partnership document. Joint stock, I mean, is when the legality, the statutory requirement is much more, and that is where you will see private limited company and you will see public limited company, which is called, you will find the name limited attached to it, LTD, as far as the Indian scenario is concerned. If it is US, it is INC. So joint stock of company is association of individual called shareholders or equity holders who join together for a profit and agree to supply capital divided into share, and even the external people can join together and invest in the funds of the company. Capital is very high and distributed control. Suppose a promoter who is part of the shareholder, even if he even a death or insolvency doesn't stop the company from operation. The company, by removing the promoter or the director of the company, the joint stock company can still go on. So based on the statutory need of a specific number of shareholders might vary. That is where it is a private limited or the public limited, and the registration need to be with the registrar of the companies, and it could be a private limited, public limited, or incorporated. The statutory requirements are much higher compared to proprietary and partnership companies, and that is where a lot of rules and regulations are there in joint stock companies. So particularly, but if you want to have the venture funding in place, then you need to have something like a private limited company. So now you have some understanding about the different types of organizations or the companies in India. Let's look at the funding requirement. There are 2 types of funding. One is the equity funding, the other one is debt funding. So it could be own funding or from family. They supply you with the capital. Then it is called the equity, and that is also called bootstrapping, your own funds, because when it is from your own funds or family friends, I mean, you can always sort it out, saying that instead of giving in this month, I will repay or give you the profit next month or subsequent quarter. So this kind of funding where you have, it is called the bootstrapping. And funding through public and private contribution, this is where the venture funding or angel investors, common tech companies like Flipkarts, for example, but just not Flipkart, there are many companies in India which are venture funded. There are now hundreds or if not thousands of companies. Thousands of companies in the last since the 2008 the financial meltdown. There are now hundreds of thousands of companies which are venture funded in India itself. So that's a point to note. This is the earlier route. They want to that is prior 2005 or prior 2000. It was through the stock exchange. It's a long process where you need to have the stocks listed in the stock market. It's a long process, but these days you will see a lot of small companies getting into attracting the venture funding route. So this is all as far as the equity financing is concerned. So through the share market. So that is equity, or your own capital is called, or the shareholders capital is called the equity funding. The other one is debt funding. So this is common with term loan, particularly if you want to procure the machineries, the capital expenses, then it is term loan. Working capital, the operating cost gap, that is for the operating the business, your raw material, procuring the raw material, your staff salary, and all are the working capital. And debt financing is through the debentures, bonds, or it could be banks through collateral. So think about two things. Techies tend to confuse, but generally it's equity financing. Then in that case, your own capital, the share capital, or the other one is debt funding, where you borrow money. The borrow money, naturally it has to be coming through the banks, or if you're a big company with the appropriate resources consultant, then you could go for the debt financing through the debentures, bonds, or deposits. So now the venture capital, this is a point in the last one decade, even in India, the venture capital is highly spoken about. Many company has tapped this, and you attract, there are companies which has attract millions of dollars, even though they have not gone profitable. Many companies were tapped the venture capital market, particularly after 2008. There are multiple companies. There are companies like Byju's, or you will see Flipkarts, who has taken this route and really grown big. They have attracted millions of dollars for running the business. Particularly if you are web-based business, the scaling up is much easier because it attracts only registration from different parts of the world. There are different types. Seed capital, initially when you have an idea, you get a seed capital, and startup, after that you get a startup round. New firms requires fund associated with product and marketing development, initial round, and then comes the second round, the operating capital provided for initial stage for selling products and getting the profit. That's the second round. And third round, when you get into the expansion, when you want to have the offices at different locations, or you want to diversify your product, then it becomes a third round. Fourth round is a bridge financing, and is proposed to go into public financing as well. That is where the shareholding, or the get it listed in the share market. And these are referred to Series A, B, C funding. And there is a new term which is called the unicorn. Unicorn company is a startup company that has a value over 1 billion. It is termed as the unicorn company, and one of the reason is, once you are valued as a unicorn company, then it attract continuous funding in spite of registering losses. So this is, though I said I wanted to cover it in 10 minutes, I've gone beyond that. So this is in a quick nutshell, in taking less time, I've told about different organization in India and how the funding can work through. So I hope you found this useful. Do subscribe to my channel. Thank you.